You've probably heard about financial freedom, being able to live life on your own terms without having to worry about money. But how do you actually get there? One of the easiest ways to start is by investing in an income ETF. These are funds that pay you regular dividends so that you can earn passive income while your money works for you. It could be a valuable tool in retirement. Now today, I'm going to be going over 10 of the best income ETFs, but I'm not just going to be randomly picking them. I'm using top secret proprietary data and criteria in order to rank these income ETFs. So let's go over what that is real quick. So the last time I made this power rankings video was on January 5th. So we're going to be putting extra emphasis on the performance since January 5th. Remember, these are power rankings. So it's, hey, how hot have you been lately? What have you done for me lately? It's not what have you always done for me. So extra emphasis since January 5th. And then we're going to be looking for no NAV erosion. Now, this is a dreaded word that a lot of the high yield dividend warriors, they like to pretend that NAV erosion doesn't exist. This is when the share price just continues to go down and down and down after every single dividend payment. What good is investing in income ETFs if by principle is going to get eroded over time? Absolutely not. No, thank you. And generally with these income ETFs, they're going to be paying out high dividend yields, but I also want my share price to kind of slowly be going up over time. I'm not saying that's the biggest and most important thing. I do like to see some price appreciation, so I do try to factor that into these rankings. And then I also just want real dividends from profits on options trading. This is where we get into the dividend talk. The dividend is the dreaded word. It's an investor's own money returned to them. This is money that's returned to them by the fund under the guise of a dividend. Not to be confused with an actual dividend. This is a payment of cash that's sent to the shareholders from actual profits of the company. In this case, with income ETFs, it's from the profits of their options trading. It's also known as a fugazi. Many of these warriors, they're getting hoodwinked by dividend fugazis. All right, guys, it's time to talk about the stocks that just missed the cut. So the first one that just missed the cut of our top 10 is NUSI. This is a NEOS product, the NASDAQ 100 income ETF. So they have a yield about 7.5%. Since January 5th, they're up almost 2% at 1.94%. Now, this is actually not a new product. This has been around for quite some time. For those that are really OGs of income ETF investing, of income ETF YouTube investing, these were one of the big three original ones with JEPI, QILD, and then there was NUSI. Now, NUSI had a really poor 2021, 2022, and a lot of people sold out. But they have apparently since changed up their investing strategy, their algorithm, and they've been doing pretty well in the past year. They're up 15, 16%, not too bad. Keep up the good work. It's another NEOS product that kind of foreshadows that we're going to be seeing more NEOS products on this list real soon. All right, just missing the list as well was SPY by Defiance. This is the S&P 500 Target Income ETF. They have a ridiculously high yield of 19%. That is really good, and they haven't had too much NAV erosion, down only 2% since their inception since March of 24. All right, just missing the list too was QDPL by Pacers. So this one is up 15% in the last year. They have almost $1 billion in assets under management. Now, something that's different about QDPL compared to other income ETFs is that they actually only pay dividends every quarter rather than every single month. So that is going to be quite the turnoff for some people. QDPL is up nearly 3% since we last made this update video. The next dividend payment actually won't come until the end of March or the start of April. So it's really hard to compare dividends over time when most of these funds are paying out monthly and this one is just every quarter. Overall, it's still up around 16% since their inception in July of 21. Number 10, QDVO, Amplify. All right, guys, so we're kicking off the top 10 with a ETF that's making its debut on the list, and it's because I got a lot of comments from you guys saying you wanted to see it on the list. So make sure you guys are leaving comments telling me what you think of these rankings, and if I'm missing any ETFs, or if you have a disagreement with how high or low I ranked a certain ETF, let me know, right? There's so many, dozens of income ETFs out there. There's no way that I can keep track of it. So that's why I always review the comments every time when I make these update videos. So QDVO, it's ran by Amplify ETF. So this is actually the same people that run the very popular ETF called DIVO. That's one that I own in my personal portfolio. It gives out around a 5% yield. It's had some pretty good success for me, but this one is more focused on growth and income. Here it's showing a 3% yield, but that's just because it hasn't been over a year since it's been out. It came out at the end of August of 2024, so this number will be bigger once it's been out for 12 different months. So they have an expense ratio of 55 basis points. That's not too bad. It's a little bit cheaper than some of these popular income ETFs, but still not super cheap. If we annualize their most recent dividend payments, we're looking at a dividend yield of around 8.5%. And they do actually pay out every month. If we look at their top holdings, we have companies in here like Apple, Nvidia, Microsoft. This makes up around 25% of the overall portfolio, and that's actually pretty crazy because if we just individually owned companies like Apple, Nvidia, Microsoft, these companies barely pay any dividends, but with this fund, you're getting an 8.5% yield. That's a way to own big tech, get high quality companies that might not always pay the most in dividends, and we're now getting that capital appreciation. We're getting nearly a 10% yield. That's just fantastic, guys. Very impressed with QDVO. I'm actually going to be working on a review of this ETF. That's going to be a totally separate video, so be on the lookout for that. Number 9, FEPI, AIPI. So FEPI was down 34 basis points since we last talked, and AIPI was down just 8 basis points. So these were not in the green since the last update, but FEPI is starting to show that around that 14% yield. I truly think that's really what the magic number is that prevents NAV erosion from happening. So FEPI actually has a ridiculous yield around 25%, but lately they've been having a trouble maintaining their NAV. Still overall only down about 2%, but we can see just in the last year alone, they're down about 12%. So that's gonna really cut into that dividend yield. Even though it's super juicy, it's still super nice. I don't know how sustainable that is for the long run. So FEPI's most recent dividend of $1.04 was actually the lowest of all time. And that yield just continues to go down and down. We can see back in the day, I'm talking about just last year, it was paying as much as $1.16, $1.18. That was very consistent when it first came out, but unfortunately, it's been heading in the wrong direction. That is not what you want to see. That is a concerning trend that their yield is going down, their NAV continues to go down. That's a recipe for disaster. For AIPI, it's kind of the same thing here. We can see their dividend has actually been pretty stable. It's went from $1.51 to $1.48. So really, it hasn't been changing too much. Once they get annualized and have been here for 12 months, we're looking at around a 34% yield with AIPI. Again, how sustainable is that for the future? I don't know. The distributions so far have been pretty consistent, but we were saying that about FEPI last year. So time will tell. For now, they're ranked number 9 in my rankings. Number 8, Kurv ETFs. So I'm just going to talk about the 2 largest Kurv ETFs in terms of assets under management. That is TSLP, which is down 15.57% since the last time we made this video. And then there's also QQQ, which was down 54 basis points. These 2 ETFs only have a combined $39 million in assets under management. So you're wondering, why did I even bother putting these on here if the performance has been really bad as of the last update? Their AUM is really low. Well, I just put out an update video on Kurv. I wanted to show them some love since people are finally starting to realize that these funds, although very small in assets under management, they've given some very impressive results. I just put their 2 largest funds by AUM, but there are other funds that they do options trading on. There's one on Amazon, on Google, on Microsoft, and those have done very well. NAV erosion hasn't really been a thing with some of these Kurv ETFs, and they've given out some really juicy dividends. If we go to their Google one, it's actually up almost 12% since their inception, since October of 2023. They pay a dividend yield of nearly 15%. I mean, that's not bad when we're talking about a company that if you just owned it outright, it would pay you like a less than a 1% dividend yield. So whatever their strategy is, it's working out really well. So they also recently changed their distribution schedule to now all the funds that they run are now staggered throughout the month to pay out weekly. Of course, a good investor knows there's absolutely no reason to be buying a fund based on when it pays out, how frequently it pays out. Just have to learn how to budget correctly and just not pay attention to silly things like that. If they continue to do well, they will go higher on this list. I just wanted to give them the credit that they deserve. Number 7, XDTE, QDTE, Roundhill. So these are the Roundhill S&P 500, NASDAQ 100, 0 days till expiration covered call strategy ETFs. Now, I literally just put out a video on them, so I'm not going to dwell on them too much here. XDTE was up 20 basis points. QDTE was up 67 basis points since the last time we made this video. Now, if we look at the dividends for XDTE, it's a little bit hard to tell since they pay out dividends every week rather than every single month. Overall, it looks to be in line with how much it was paying in the past. For XDTE, that's around 20 cents, and then QDTE, it's a little bit higher at around 25 cents. Not bad at all. Honorable mention, YMAX, MSTY. You know I had to make fun of the Warriors. My top 10 list is prime real estate. I don't have space on this list for garbage funds. The Warriors put their life savings into MSTY, and it was down 13% since January 5th. And keep in mind, in my previous power rankings video, it was also down 13%. So that means there's been back-to-back unlucky number 13% drops for this ETF. Perhaps it's the universe giving a prophetic sign that taking a loan against your house, spending your kid's college fund to gamble on a virtual cryptocurrency because Michael Saylor says he can make you rich is maybe not the best idea. Now, many of these Warriors, they got margin called. They were panic selling, worried about the future. Meanwhile, smart investors like you and I, we were laughing as our portfolio hit all-time new highs. Imagine being in retirement and seeing your portfolio value go down by nearly 1/3 in the matter of a few months during a bull market. I just want to emphasize how hard it is to underperform by that much during good times in the markets. This is about to be the shortest retirement ever for the high yield dividend warriors. Remember, I made a video not too long ago about a question on YieldMax Reddit. It goes, why not just go all in on MSTY? What is the risk? It actually frequently appears every now and then. Yeah, this is exactly why you don't do it. I heard MicroStrategy had a name change that almost sounds satirical, but it's actually true. I don't want to distract us from actual high quality investments, so let's get back on track. Number 6, BALI, BlackRock. Now, BALI is up 1.41% since January 5th. BALI has about 145 different positions, including its options trading, with Apple, Microsoft, Nvidia making up the largest positions. So they're seeking to get enhanced monthly income by purchasing dividend stocks and selling call options. Their last dividend of 17 cents was slightly lower than their previous two distributions of 23 and 20 cents. Looks like BALI can give us around an average of 18 cents looking at their overall dividends chart. Remember, until March 31st, so at the end of next month, BALI has waived their fees, so no expense ratio until the 35 basis points kicker. That starts again on April Fool's Day. So BALI has a lower overall yield of about 7%, but it's given us some pretty good juicy capital appreciation since it's been out, 25% since September of 2023. Low expense ratio, monthly dividend payments, what's not to like with BALI? Number 5, QQA, Invesco. So this is the Invesco Triple Q's Income Advantage ETF. It hasn't been around for that long, only been around since July of 2024, but it's quickly growing in AUM, almost at $200 million now. People are starting to realize that this is a fantastic income ETF. So if we look at their chart of dividends paid, their most recent dividend payment was 44 cents. That's almost exactly what it was last month. In other months, they've consistently paid around 41 to that 44, 45 cents. Very consistent. They're up nearly 8% all time. And this is another one where Invesco has waived the management fee until the end of June. So we're getting this great product for free, essentially. Somebody is managing it for free, and then it goes back to 29 basis points, a super low expense ratio. You might be asking, why are they waiving these management fees? These are newer funds. They need to attract new investors. So then people might be more willing to invest with them, and if they see that they like it, they'll probably just keep their money parked there. That's what they're hoping to do, and then they'll bring that fee back in. Now, companies like Invesco, BlackRock, they're multi-billion-dollar companies that have been around for decades. So they're able to do things that newer companies that probably don't make as much money yet, such as Roundhill, YieldMax, they wouldn't be able to just waive their fees, right? Because they actually need that to run the business. Number 4, JEPI, JEPQ, JP Morgan Chase. Well, speaking of gigantic companies, we're almost at the podium. Now, JP Morgan Chase reported a record quarter, and its 2 premier income ETFs continue to impress. JEPI was up 2.05%, and JEPQ was up 2.08% since January 5th. Very good indeed. Now, JEPI is now at 39 billion, that's billion with a B, in assets under management, and is rapidly growing. It's giving around a 7% yield. JEPI has been around for quite some time, all the way back to 2020. It's about to hit its 5th birthday in May, and so far it's returned 18% in capital appreciation. JEPQ is also rapidly growing. JEPQ is now at $23 billion in assets under management. All time, it's up 18%. Been around almost for 3 years now. It gives us monthly dividend checks, and they have a yield of about 9.5%. All right, if we go to their dividend history, so JEPI's latest dividend was just 33 cents. This is actually the lowest dividend it's had since August of 2024. We just have to hope for bigger ones next month. And it's a similar story for JEPQ. Their 45-cent dividend payment in February was also their lowest since August. Overall, they're still doing pretty good for the year, and the dividend is still pretty fat. Number 3, SPY, Triple QI, NEOS. SPY was up 1.91%, and Triple QI was up 2.38% since the last update. We have finally reached the podium. Number 3 is the NEOS products. NEOS continues to impress. The people that run NewC also run SPY, and then IWMI. These are just a basket of some really great income ETFs that NEOS continues to put out on different indexes. Now, they're using their own data-driven call option strategies on these indexes. They're taking advantage of tax loss harvesting, and there's some chances of some real capital appreciation as well. Now, SPY, they've been around for about 2.5 years now. There's about 7.5% in capital appreciation, and they've given a dividend yield very impressive, almost 12%. I mean, getting a 1% return every single month, that is a really rapid-fire way of building wealth, maintaining wealth, and paying for living expenses. If we look at Triple QI, now they just turned 1 year old. They have about $1 billion in assets under management. They're giving a yield closer to 14%. And so far, there's been 8% gains in capital appreciation, which is crazy good. I mean, an 8% in the last year in capital appreciation, 14% dividend yield. That is super juicy. Like, the juice is real with this one.
Oh my God, it's so juicy.
And people are really starting to realize how great QQQI is. And just in the last 3 months alone, over $330 million have poured into Triple QI because investors want these impressive results. They don't want any more fugazis with dividends. This is real income. They're also really consistent with how much they pay in dividends. Triple QI's latest dividend of 62 cents was basically the same as they've been paying in most recent months, around that 60 to 61 cents. August was 64 cents. So very consistent dividend payments there. SPY's latest dividend was 52 cents. Again, very consistent with how much it's been in other months. So this is really the best of both worlds. So we have a healthy NAV and we have steady, fat dividends coming into our portfolio every single month. See, guys, it is possible if you're patient and if you evaluate for high quality companies, not just chase the highest dividend yield, good things can happen. Number 2, ISPY, IQQQ, ProShares. They've had some nice capital appreciation in the last month. ISPY was up 2.08% and IQQQ was up 2.65%. They're doing the sale of daily call options and swap agreements not directly trading options, but they are getting that high income. Now, ISPY is giving around a 9.2% yield. Now, one thing I really don't like about these two ProShares ETFs is that their dividends are really all over the place. For example, ISPY's latest dividend was 33 cents, but the month before it was 22 cents, then 30 cents, then up to 38 cents, 34 cents, and then we had one in September that was 62 cents. IQQQ was even more ridiculous. Their latest dividend was 45 cents. Before that, it was 16 cents, then 34 cents, then 10 cents, then back again to 32 cents. So it's gonna be a little bit hard in retirement to be planning to make a budget for expenses if the income is going to be this sporadic. Overall, the funds are still really good. IQQQ has been around since March of last year. They're up 8.14%. ISPY is up 13.5% all time, which is about 15 months for them. And their expense ratio of 55 basis points is also cheaper than NEOS at 68 basis points. Now, before we get into number one ranked income ETF, make sure you've joined the Discord in the link below. You don't need to wait every 6 weeks for a new Power Rankings video to come out. We have some fantastic conversations about investing daily in the Discord every single day. And we also make fun of the high yield dividend warriors. Number one, GPIQ, GPIX, Goldman Sachs. Oh man, this is the granddaddy of them all. No fund can even come close to how fantastic these two ETFs are. GPIQ was up 2.76% since January 5th. GPIX was up 1.98%. These are the model of excellence that all income funds should strive to be. GPIQ just gave their fattest dividend of all time, 44 cents. That is just straight juice. GPIX, same thing every month. It's like they're just raising the dividends. They actually tied for their biggest, fattest dividend at 36 cents. This is an amazing track record of just capital appreciation and increasing dividends. If we look at GPIQ, it's up 31% all time. They've been around since October of 2023, and to go up 30% while also giving nearly a 10% yield, that is just insane. You're also getting pretty good diversification, right? This is going off the NASDAQ 100, so you're gonna have some pretty powerful tech companies in here. And then you're just getting those big dividends, right? If you invested in the triple Qs, you would have like a less than a 1% yield. Here you're getting a 10% yield, and you're also getting capital appreciation. Of course, this is everything they've done in the past. Doesn't guarantee that they'll do this in the future, but we're also getting a super low expense ratio of just 29 basis points. Some of these bigger companies like the Goldman Sachs, they can afford to get those expense ratios low, but that's good news for us investors. That's less money that we're paying in management fees, and that's more money that we can have in our pockets. Now, these guys have sat on top for a while. It's okay to bandwagon. High yield dividend warriors. When you finally admit that you're tired of losing money, there's actually funds that make sense to invest in. You might be a little bit confused, right? You're looking at this chart and you're a little confused. Why is it going up over time, up and to the right? You might be confused that the chart is actually going up and to the right and not down. This is a fund that actually makes money. All right, guys, come join me and other dividend investors who are retiring early in the Discord link below. Leave a like for a small time creator. My videos are always found in podcast form under the Collect Cash podcast name.
Okay, so the darling of my portfolio, the darling of high yield dividends, the most beautiful girl in the room is Misty. She literally took the crown away from Tesla.